Active measures of the US government and large banks aimed at helping First Republic Bank to avoid bankruptcy slightly calmed down traders and boosted demand for risk assets. What's more, traders are pricing in the ECB's decision to raise the benchmark rate by 50 basis points in such an uncertain period of time. However, very soon they will shift their attention to the FOMC meeting that is scheduled for Wednesday. In our video review, we will talk about this and other important events of the first part of the next trading week. The flow of macroeconomic events will start again on Tuesday. Thus, during the Asia-Pacific session, the Reserve Bank of Australia will disclose its monetary policy meeting minutes. Notably, in March, the central bank raised the benchmark rate by 25 basis points, which was the 10th hike since May 2022. Now, the key interest rate is at its peak since May 2012. Announcing its decision, the Reserve Bank of Australia emphasized its goal to return inflation to the target of 2 and 3% and its intention to keep the economic stability. Such rhetoric reflects the regulator's readiness to raise the key rate higher. Against the backdrop, the Australian dollar may gain in value. Notably, the stance of most central banks may change in a moment amid the ballooning banking crisis in the United States and other countries. Thus, data on Germany's economic sentiment has already reflected the influence of the crisis. In March, the ZEF economic sentiment may drop to 20 points. In February, the indicator managed to reach the level of 28.1 points for first time in a year. However, it will hardly stay at this level. That's why the investment attractiveness of the euro will decline. Let us return to the problem that the whole world has been solving for more than a year already. On a Tuesday, Canada will disclose its Consumer Price Index report. Notably, in Canada, the issue of a high inflation is being tackled more successfully than in other countries. In January, the Consumer Price Index was already at its lowest level since February 2022. In February 2023, inflation may slacken to 5.2%. Investors will hardly benefit from such information since the Bank of Canada has already paused the monetary policy tightening. If inflation continues to slow down, the regulator is unlikely to resume raising the benchmark rate. Against the backdrop, investors are expected to put their money in the US dollar as the Fed is ready to hike the key rate more. The Bank of England is also ready to go on raising the key interest rate. Its fight against inflation is not that successful. The consumer price growth is still double-digit. However, analysts suppose that in February inflation may slide below 10% to 9.9%. Although it's still a very high level, it will be the lowest one since August 2022. In other words, the Bank of England has to take measures to cap inflation, regardless of the recession signs. The Fed's decision on the key rate is the most awaited event of the month. This is also the main driver of speculative activity in the market. Forecasts have been changing constantly, and thus Jerome Powell's comments spurred expectations of the 25 basis point rise. Then the likelihood of a 50 basis point hike increased amid the overheating of the US labor market. Finally, the collapse of the US banks may force the Fed to keep the benchmark rate unchanged or even cut it. Against the backdrop, market volatility is expected to be very high. Nevertheless, we wish you profitable trading. How we're going to be in the short term in financial markets, we will definitely tell you in our next news releases. Subscribe to our channel and follow news with us. See you soon!